So, if you really want to understand just how incredibly powerful an S corporation can be, honestly, we need to look no further than a massive, high-profile, real-world example from just a few years back. Check this out. President Joe Biden's 2017 and 2018 tax returns showed that a huge chunk of his income, we're talking almost $3 million, from speaking gigs and writing after his book release, flowed directly through an S corporation called Celtic Capri Corp. Now, here's the kicker. He only reported $300,000 of that as actual compensation. By structuring it exactly this way, he legally, completely legally, avoided employment and self-employment taxes on the vast majority of Celtic Capri's earnings. That is some serious tax strategy in action.
And the thing is, this powerful tax strategy, it isn't just a loophole for presidents. It is baked right into the DNA of the U.S. tax code. But let's be real, navigating that tax code can feel a lot like trying to read a foreign language in the dark. So in today's explainer, our whole goal is to translate these incredibly dense IRS rules into a concrete, chronological journey. We're going to demystify the entire S corporation life cycle, starting from its birth, walking through its day-to-day operations, right down to how it might potentially be terminated. Here is our roadmap for today. Number 1, the S corporation hybrid. 2, qualifying for S status. 3, tracking income and basis. 4, navigating corporate distributions. And finally, number 5, terminations and tax traps. Let's get right into it.
Starting off with Section 1, the S corporation hybrid.
Okay, before a business can actually start leveraging these rules, we really need to understand what an S corporation even is and why on earth it exists in the first place. You see, an S corporation isn't some entirely new beast. It's actually a hybrid. Think of it like a crossbreed. On one side, you've got the standard C corporation. This offers fantastic legal protections, but it gets hammered with entity-level taxes. That means the corporation pays tax on its profits, and then bam, the owners get taxed again on their dividends. Double taxation, not fun. Now, on the other side, you've got a partnership. Partnerships enjoy what we call flow-through taxation, meaning the business itself pays absolutely zero tax. But it lacks some of the robust, rigid structures of a corporation. The S corporation? It sits beautifully right in the middle. It takes the strong, bulletproof legal protections of a C corp and marries them to the flow-through taxation of a partnership. It's basically the best of both worlds, as long as you can follow the rules.
Which brings us nicely to Section 2, qualifying for S status.
Because it's such an incredibly powerful tax tool, the IRS doesn't just hand out S status to anyone who asks. No way. There are strict, and I mean incredibly strict, birth requirements a business must meet. The most crucial one, this hard cap right here, 100. An S corporation can literally have no more than 100 shareholders, period. This is exactly why you will never ever see a massive tech startup like Uber operating as an S corp. Venture capital firms are usually structured as partnerships, and partnerships are strictly forbidden from being S corp shareholders. Plus, the second a company scales to thousands of investors, it instantly shatters this 100-shareholder rule. But hold on, because there is a massive loophole here, and it is fascinating. For that 100-shareholder limit, the IRS actually treats family members as just one single shareholder. And their definition of family? It's surprisingly broad. We're talking about a common ancestor going back up to 6 generations, plus all of their lineal descendants and all current or even former spouses. So what does this mean in reality? It means a gigantic multi-generational family enterprise with great-grandparents, cousins, siblings, the whole shebang, can hold shares and still only take up one single slot out of that 100 limit. Pretty wild, right? Let's anchor this with a quick case study from our source material. Imagine a company called Color Comfort Sheets, or CCS. 3 people form this business: Nicole, Sarah, and Chance. Because they are all individual U.S. residents, they are perfectly eligible to hold S Corp stock. No problem. But what if Chance decided, hey, I want to hold my shares inside my own C corporation, Chance Inc.? Well, that S election would be dead on arrival. Why? Because S corporations can generally only be owned by U.S. individuals, estates, and a few specific types of trusts. Corporate entities and partnerships are completely, strictly ineligible. Moving right along to Section 3, tracking income and basis. So assuming we've jumped through all the hoops and qualified, we now move into the daily operational life of the business. This is where we get into the nitty-gritty of tracking how the money actually flows to the owners. And what's really interesting here is the actual tax form itself, Form 1120S. Now, the S corporation still has to file an annual tax return with the IRS to report its sales, its costs, its deductions. But remember, it's a flow-through entity.
That means the bottom line on this form generally isn't taxed at the corporate level. The business files the paperwork, sure, but it doesn't write the check to the IRS. Instead of the corporation paying the tax, that income gets chopped up into pieces and sent to the shareholders on a document called a Schedule K-1. Here we can see Nicole Johnson's real-world Schedule K-1. Her exact proportional share of the business's ordinary income, as well as any separately stated items like interest and dividends, flows directly onto this form. Nicole then takes this K-1, hands it to her accountant, and plugs those numbers into her own personal 1040 tax return. She pays the tax out of her own pocket, not the business.
Now, because the shareholders are paying taxes on this income as it's being earned, we have to make absolutely sure they aren't double taxed when they finally decide to take the physical cash out of the business later on. We do this by rigidly tracking what's called their stock basis. Think of it as a strict mathematical order of operations. First, you add any capital contributions you put in. Second, you add your share of the income and gains that you were just taxed on. Third, you subtract any cash distributions you take out. And finally, you subtract your share of any losses or expenses. Oh, and your basis? It can never, ever drop below zero. Tracking this accurately is literally the lifeblood of a successful S-corporation tax strategy.
Let's look closer at those distributions in Section 4, Navigating Corporate Distributions.
All right, now for everyone's favorite part, the payday phase. We need to figure out what happens when the S-corp actually hands out cash or property to its owners. If your S-corporation was born an S-corporation and never spent a day operating as a C-corporation, payday is wonderfully, beautifully simple. Taking cash out of the business is completely tax-free up to your stock basis amount. Because you already paid taxes on that income when it showed up on your K-1, pulling the actual cash out later doesn't trigger a second tax. It just simply lowers your stock basis. Easy, right?
But what if your S-corp used to be a C-corp? Well, this is where Congress steps in and sets up a surprisingly complex bucket hierarchy. You can't just dodge taxes on old C-corp profits by sneakily switching to an S-corp. If your business has old C-corp earnings and profits, often called E&P, distributions have to follow a very strict order. First, money gets pulled from the Accumulated Adjustments Account, or AAA. That represents your S-corp earnings, so that part is tax-free. But once that AAA bucket runs dry, the money starts pulling from the old E&P bucket. Those are past C-corp profits, and guess what? That gets taxed as a dividend. Only after that second bucket is completely empty do you finally return to your tax-free stock basis. It's like a giant tax puzzle you have to solve perfectly.
Finally, Section 5, Terminations and Tax Traps.
Understanding all those rules we just went over is absolutely crucial because failing to navigate them can permanently strip your business of its golden S-corp status, and that puts you face to face with the IRS. We mentioned those strict rules for qualifying earlier, right? Well, if you break them, the consequences are immediate. Let's go back to our color comfort sheet story. If our shareholder Chance decides to sell his shares to his own C corporation on, say, a random Tuesday in June, the S election doesn't just quietly end at the end of the year. No, it is automatically and involuntarily terminated on that exact day. The company instantly reverts back to a C corporation, completely blowing up its tax landscape and creating a massive headache of short tax years that suddenly have to be filed.
And that leads us to probably the single biggest misconception out there. We've said throughout this explainer that S-corporations are flow-through entities that don't pay tax. But is that actually a 100% hard rule? Do they ever just straight up write a check to the government? Well, the answer is yes, specifically through a trap known as the built-in gains tax. Congress created this corporate-level tax for one very specific, very targeted reason: to stop C corporations from converting to an S-corp right before they sell off highly appreciated assets, just to dodge double taxation. If a C corp converts, any built-in gains on assets it holds on day one of that S election are tracked for 5 full years. If the company sells those assets during that 5-year window, the S corporation pays a hefty 21% tax directly. Boom, trap sprung. And wait, there is another potential trap for former C corps, called the excess net passive income tax. If a former C corp has old earnings and profits just sitting around, and it starts generating way too much passive investment income, we're talking things like royalties, rents, or dividends that exceed 25% of its gross receipts, it gets hit with another entity-level tax. And it gets worse. If it does this 3 years in a row, the S election is completely and utterly terminated.
So we have seen the incredible power of the S corporation. It can save you massive amounts on employment taxes
and it beautifully sidesteps the double taxation of a C Corp. But, as you've also seen, it comes with incredibly rigid rules you have to follow to keep it alive, from that hard 100 shareholder limit to the meticulous tracking of stock basis, and those serious traps just waiting for former C Corps. It's a lot to weigh. Which leaves us with a critical final thought to consider for your own entrepreneurial journey. Do the strict, uncompromising operational limits of the S Corporation outweigh its immense tax advantages for your specific business?